Hello everybody, welcome back to another valuation investing video, and today in this video I'm going to be going over 3 stocks that are near their 52-week lows, in which I go over stocks that are near their 52-week lows because this could be a good starting point for us to find companies that are trading at a lower valuation relative to the past year in their stock price. So these 3 stocks are going to be UPS, Berkshire Hathaway, and UnitedHealthcare today. These 3 stocks are close to their 52-week lows, so with that being said, let's get into the first company, which will be UPS. And taking a look at UPS, this company is down over 31% in the past year. And taking a look at the 52-week low, it's at $84, and right now the stock's at $86. So this company is very close to its 52-week low, which was hit just recently, just about a week ago. So with that being said, looking at the market cap of UPS, this company's valuation is at $73.46 billion, so that's how much this company is worth right now. And then the dividend yield is insanely high at 7.57%. I personally think that they should be cutting this dividend because with a dividend yield so high, with a company like UPS, I would want to see them reinvesting back into the company instead of paying such a high dividend. And I'm going to guess that in the future, they're going to have to cut this dividend just because this is going to be too much for them to pay out in the future. So with that being said, taking a look at why UPS stock is down, we can see it is because of disappointing earnings and lack of guidance from last quarter. In their recent earnings report, they missed their profit estimates and management declined to provide an updated full year forecast. So the lack of guidance is unclear and uncertain for investors, which is why the stock was down so much after that earnings. Also, the impact on tariffs and trade conflicts is affecting UPS profitability and also could reduce the company's shipping rates. Also, the shift in business strategy is potentially hurting this company. They're trying to shift to more of a higher margin business, getting away from Amazon. So with that being said, they're trying to get to a higher margin to get more profit in the future, but right now in the short term, it's not looking too good for them since they're reducing its business in Amazon. Also, the questionable capital allocation has been concerning for investors and also the economic conditions and competition because of FedEx and Amazon's shipping. It could generally slow down UPS in the future. Taking a look at the financial health of UPS, we can see here we have 5 out of the 7 key metrics that I like to look at, and as we can see with the P ratio, it is greater than 0, meaning UPS is a profitable company, and it's at 13. Compared to the stock market that's trading at about a 25 P ratio, this is a very low valuation compared to the market because a lower P ratio means that this company, you're going to be paying less for $1 of earnings per share. But that doesn't mean you should be buying this company because we have to take a look at the full picture of UPS, especially with the growth rates and the future of this company. With the forward P ratio, we want to see that less than 30, and as we see right here, it's also at a 13 forward P ratio. So this is looking like a very low valuation for UPS, but it makes sense because looking at the revenue growth, only growing at 4% each year for the past 5 years, this is very slow revenue growth, and that's why the P ratio is so low. So with that being said, it would almost be better to buy another company that has a higher P ratio and a higher revenue growth rate. So even though the valuation is very low, it is for a reason because of the growth rate is also so low. Also, the EPS growth rate is at 5%, in which I want it greater than 5%, but it's right in line with what I want it to be at about 5%, so that's fine for UPS, but ideally I like to see it at about 10% for most companies or greater, but it's still a check mark nonetheless. Also, they are buying back shares at 1% each year, so at least they are returning some back to us investors. I would rather see them cut the dividend and buy back more because dividends are less tax efficient because you get double taxed on dividends, but if you buy back shares, UPS only gets taxed once on that. Also, the debt to equity ratio is insanely high at 183%. So they have a pretty good amount of debt, which is a bit of a worry for me, but it's not too bad if you compare the amount of debt compared to their free cash flow. They have about $7 billion in free cash flow and about over $20 billion in debt. So if they really wanted to, they could pay that off in about less than 5 years, so it's not terrible. And analysts actually surprisingly do expect this company to grow about 8% each year for the next 5 years. So this is a little bit higher than I expect, but this, take in mind, is the EPS and not the revenue. So looking at my intrinsic value calculator for UPS, I have to do the annual revenue growth rate assumptions. And I think that for the bear case, I think for the next 5 years, UPS could probably grow at about a 3% rate. Analysts do expect them to grow about 8%, but I think that is too high, and that's also for the EPS. And over the past 5 years, they've been growing at 4%. So with that being said, I think for the bear case, 3% is fair. For the base case, I'm going to put 5%, and then for the bull case, I'm going to put a 7% growth rate each year. Now for the future profit margin. Taking a look at their profit margin here, we can see that over the past 5 years, it has been kind of all over the place, but it has gone back to basically normal because back here during 2021, this was around COVID times, and they really had a lot of shipping during that time. So they had a lot higher profit margins, but now it's gone back to normal at about 6%. So with that being said, taking a look at the future profit margin, on the bear case, let's put a 5% profit margin. For the base case, let's put 6%, and then for the bull case, a 7% profit margin. Now for the bear case for the future PE ratio, right now they're trading at about a 13 PE ratio. I think for the bear case, we could put an 11 P ratio. For the base case, let's do 14. And then for the bull case, let's do a 17 PE ratio. Since this company isn't going to be a fast-growing company, they definitely deserve a lower valuation than the stock market. Also, now for the shares outstanding for the bear case, they're buying back at about 1% each year. And I think for the bear case, they'll only buy back at about 0.5%. Now for the base case, let's say they continue to buy back at 1% each year. And for the bear case or bull case, say they buy back at 1.5%. With that being said, with dividends included, I think for the bear case, you can make about a negative 4% return. For the base case, 6%, and then for the bullish case, I think you can make a 17% return. But me personally, I'm not interested in UPS because of the slow growth rate of this company. Me personally, I like to invest in companies that are growing at least 5% or greater, and their revenue growth rate is less than 5%. So honestly, unless this company got to an insane valuation of say like $70, even $70, I don't think I would even be buying UPS. So with that being said, I think UPS, you should be staying away, but this is not financial advice. Do your own research. If you think this company is a buy, then go ahead, go buy it. But me personally, I'm not buying this company right now. And the next stock I'm going to be looking at is Berkshire Hathaway, and although this is a video on 52-week lows, we can see the stock is actually up 7% in the past year. But the 52-week low is actually at $425, and right now we're at $465. So we're pretty close to that 52-week low, so I decided to put this in the video since it's really close to that 52-week low, and it has been trading down a decent amount. This company is nearly a $1 trillion company, and they have no dividend yield. And with that being said, taking a look at why this stock is down is mainly because Warren Buffett is stepping down from the company because he was the CEO, and he was basically the GOAT investor. He would make such great returns, and Berkshire Hathaway, if you didn't know, is basically a holding company where they basically just invest in other companies and own other companies. So that's probably why this company is trading down. Also, disappointing earnings reports and major write-downs. They had a little bit of disappointing earnings in which they had a bad write-down on Kraft Heinz, which was a long position for them, and that investment has been doing very bad. Also, lagging in a risk-on market is because this company is a more defense stock in which people probably aren't going to be investing in this company since it is a kind of boring company. Also, they have a huge cash pile of $340 billion because they're not really investing in anything right now. And then also succession risk concerns because who is going to be taking over for Warren Buffett, and if he can actually do good, Greg Abel, if he can be a good CEO. So with that being said, looking at the financial health of Berkshire Hathaway, we can see that the P ratio is greater than 0 and profitable at a 15 P ratio. Also, the forward P ratio is at 22, which is less than 30, but the one thing I don't like is how the forward P ratio is greater than the PE ratio. That means analysts expect the earnings per share to be less in the next year than it is right now. So that's a little bit of a concern to me, but honestly, Berkshire Hathaway, the way their accounting is done, if you looked at their revenue and their earnings, you would see a big gap and just huge variability in that just because of how the accounting is done with Berkshire Hathaway, since it's a holding company. So I wouldn't be too worried. And looking at the revenue growth, they're growing at about 8% each year, but the EPS growth is only 2%. Like I said, it is mainly to do with the accounting of this company, and it's not necessarily that they're losing money. It has to do with their entire portfolio and if the investment's down and up, and if they're selling certain investments at certain times. But I do like how they're buying back 3% each year. They're really good at buybacks and why Warren Buffett is a big advocate for these buybacks. Also, the debt to equity ratio is very low, meaning that they have a pretty good balance sheet. And analysts expect this company to still be growing at a pretty decent rate at about 7% for the next 5 years each year. So with that being said, looking at the intrinsic value calculator, for the future annual revenue growth rate, I think for the bear case, we could do a 5% annual revenue growth rate since there is fears that since Warren Buffett is going to be leaving that this company might be growing at a slower rate. For the base case, I think 7%, and for the bull case, I'm going to do 9%. Do I think that they're going to grow at 9% each year? Probably not, but this is a bull case. Now for the future profit margin. Taking a look here at the future profit margin, we can see over the past 5 years, it has a lot of variability, but once again, that is with the accounting of this company. It's not necessarily that they actually lost money during this time, but it's just because the market was doing bad during this time, their investments weren't doing good. They didn't necessarily sell at a loss, it's just on paper, the unrealized gains weren't good. So with that being said, right now they're at about a 22% profit margin, and I think in the future with the bear case, let's have a pretty big range of this since it is a lot of variability in this. For future profit margin, let's put 18. For the base case, a 23 profit margin, and then for the bull case, we'll do a 28% profit margin. Now for the future PE ratio. Like we saw, right now they're at about a 15 PE ratio, and I think that's actually pretty fair for this company that's growing at about 7 or so percent. It's not a very fast growing company, so I don't think that they deserve a 25 PE ratio like the market. I think that a fair PE ratio could be, on the bear case, I'll say 15, for the base case, 18, and then for the bull case, 21, just because I think this company has a pretty big moat, and they have a lot of companies that are pretty good, and I think that no other company can really become like Berkshire Hathaway is right now, and I think you should be willing to pay more for a company like Berkshire Hathaway. Now for the shares outstanding, right now I think for the shares outstanding, they've been buying back at about 3% each year. So with that being said, say they buy back on the bear case at 2%, for the base case 3%, and for the bullish case, say they buy back at a whopping 4% each year, we can see actually I get a very good return with Berkshire Hathaway at about 8% each year for the bear case, 22% for the base case, and 35% for the bull case. So if you believe these assumptions, I think this could be a good value. But say we did reduce this PE ratio to right now, it's still a 17% return on this company. So I think Berkshire Hathaway looks pretty good right now. I would be a little bit worried just because of Warren Buffett stepping down. You're probably not going to see as good returns because of him stepping down, and the investments that they're going to be making in the future might not be as good. So with that being said, I might not be buying Berkshire Hathaway now. And also, if you look at what Warren Buffett says about this company, he says the best time to buy this company is if it's less than a 1.2 price to book value. And right now it's at about 1.35 or 1.4. So in his standards, it's a little bit overvalued, but with this intrinsic value calculator, it does show that it's undervalued. But the problem is, I don't think this is the best thing to use for a company like Berkshire Hathaway, since they're kind of a holding company and they have a lot of insurance. So it's kind of hard to value a company with this type of calculator like that. But nonetheless, I don't see you going wrong with buying Berkshire Hathaway, especially since that near a 52-week low. So that being said, Berkshire Hathaway definitely looks better than UPS. And now for the last company, we have UnitedHealth, in which the company is down 55% over the past year. The 52-week low is at $234, and right now, as we can see, it's at $251 or so. Has a dividend yield of 3.52% and the market cap of $227 billion. So this company has seen a huge decrease in stock price because of the concerns over the future of how much their profit margins will decrease in their premium pricing. And taking a look at this, the main reason is because of the soaring medical costs and margin compression. Like I said, their ratio has been rising sharply and their profit margin has been decreasing very fast because of the increase in medical costs. Also, the dramatic earnings guidance revision, they previously had a $30 of earnings per share for this year. Now it's all the way back down to $16, which is nearly a 47% cut in their guidance just in a year. So this is very bad for UnitedHealth. Also, the regulatory scrutiny and investigation, they're under investigation by the DOJ for basically over exaggerating the customers' illnesses in order to get more money for their Medicare. So with that being said, that's a little bit of a concern for me. And also the management and leadership changes have been very concerning. They've had multiple CEOs over the past few years, and it's just been getting worse and worse because CEOs keep resigning. The first CEO got assassinated, so this company has had a lot of leadership changes, and also the broader healthcare industry has had a lot of headwinds with a lot of higher costs in this business. And with that being said, the financial health of UnitedHealth, we also get 5 out of the 7 for UnitedHealth, similar to UPS. We have the P ratio greater than 0 at 11, forward P ratio under 30 at 15. Once again, the forward P ratio being greater than the P ratio just means that in the future, analysts actually expect the earnings per share to decrease, which we want to see that increasing. For the revenue growth rate, they've been growing at 11% each year for the past 5 years. So this is very good growth, but the thing that's bothering me is the EPS growth rate. They've been only growing at 1% each year, and the reason for that is because the recent drop in their earnings per share just over the past few quarters due to the higher costs reducing their profit margins, which in turn reduces the net income. Also, they've been buying back at about 1% each year, and they're actually starting to buy back a little bit more after the big decrease in stock price. So that's actually good for this company and shows confidence. The only other thing that's bad is the debt to equity ratio at 76% is a bit high, but it's not too bad. And then analysts expect this company to grow still at 10% each year for the next 5 years. So going to my intrinsic value calculator for the annual revenue growth rate, I think for the bear case, we could say that this company could grow, let's say 5% for the bear case each year. For the base case, I'm actually going to put 8%, and for the bull case, let's do 11%. Since the company has been growing at 11% each year for the past 5 years, and in their recent earnings report, year over year, they grew, I think, at about 12 or 13%. So I think the bull case is still definitely achievable, but the hardest thing here is going to be the profit margins. Taking a look at the profit margins here, we can see it's been decreasing basically every year, and although in the recent earnings, we could see it was at 5%, they haven't put in the recent earnings that was from about a week ago. So with the recent earnings, this has all actually gone to lows over the past 5 years, and it was actually at about 3%. So with that being said, for the future profit margin, for the bear case, I think that they could get to about 3% for the bear case. Right now they're at 3%, but this is for the next 5 years at what I think they could be at. And for the base case, let's do a 4%, and then for the bull case, a 5% profit margin. Now for the future P ratio, like we saw, they're trading at about 11 P ratio, but that will decrease because of that profit margin decreasing. So for the future P ratio, I think for the bear case, let's do 12. For the base case, let's do 14, and then for the bull case, let's do 16. Now for the shares outstanding, since they're buying back at about 1% each year, let's say they buy back at about just 0.5% for the bear case. For the base case, let's say they buy back at 1%, and for the bull case, say they buy back at 1.5%. With that being said, right now, I think I get for the base case almost a 10% return on your investment. For the bear case, you're going to get a negative 3%, and for the bull case, you can get 21% return. So with that being said, this company doesn't look too bad right now, but I would say that this company still worries me just a little bit because just about the situation of this company. I would probably wait for the DOJ for a little bit, and I think it's a little bit worrying, but if you're willing to stomach some potential short-term losses, this could be a good buy right now. And say they somehow got back to 6% profit margin like it was, you can make 18% return with the base case. So it's all dependent on how this profit margin will be in the future. And if it's at 5%, you can make 14% on your total annualized return. So that's really the big case with UnitedHealth. What will their future profit margin be? And if it's greater than 4%, you're going to make a good return on this company. However, if it doesn't get over 4% in the next 5 years, this could be a pretty bad investment. And that's the only real worry with UnitedHealth. So with that being said, thank you guys for watching this video on 3 stocks to buy near a 52-week low. Please subscribe, hit the like button, comment down below what stocks you want me to analyze next. Also, give me some feedback on this video, and thank you guys for watching. See ya.